Hello and welcome to this session. This is Professor Farhat, in which we will start a new cycle, a new auditing cycle, and specifically we will be covering the cash cycle. Now, the cash account by itself should be very familiar with us. Why? Because this cycle was touched in every other cycle. Huh? What does that mean? It means every time we looked at a cycle, the revenue cycle, the expenditure cycle, the payroll cycle, the acquisition cycle, in every cycle we saw the cash account because cash influence every other cycle. So that's very important to keep that in mind. And I will keep repeating this today several times. To kind of set the ground on how we audit cash, we need to understand that we have to have some prior knowledge from other cycles. But in this session, we are going to look at the types of accounts we could have for cash, which are the general cash account, the Imprest account, a branch account, cash equivalent, petty cash. Are these the only type of accounts that we could have? No, absolutely. We could have many other accounts. As long as we know how to audit the general cash account, the other cash account can be audited in a similar manner. So our focus throughout will be on the general cash account, but you need to understand what the other accounts are, because whether you are studying this for the CPA exam or in practice or for a college course, you need to know the different type of cash accounts. One more thing you need to be familiar with is the bank reconciliation. The bank reconciliation is a very important document as far as internal control for cash. In this session, we will familiarize ourselves with it. Why? This is not a intermediate accounting or financial accounting course. The assumption here is you know what the bank reconciliation. Nevertheless, I'm going to familiarize yourself with it. Just go back and review it very briefly. But if you want more in depth, you want to go to Farhat lectures and look at my intermediate accounting bank reconciliation, whether you want to look at a basic bank reconciliation and financial accounting, or more intermediate in my intermediate accounting, where I cover a more advanced bank reconciliation. But that's the plan today. Look at the type of account, set the ground for the auditing cycle. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Our audit course is best for online students and students who are struggling in their audit courses. We cover the essentials from audit reports, internal control, ethics, evidence, sampling, planning and materiality, assurance and non-assurance services, and of course, the accounting cycles. Our comprehensive course includes lectures, multiple choice, true-false questions. Go ahead and start your free trial today. We are here to help. Your success starts here. The first thing we would look at is the general cash account, and that's the king account. That's the centralized account where the organization records all cash receipts and all cash payment. This is the main account. And we could have more than one cash account, more than one general cash account. But what we mean by the general cash account, it means all the payments and receipts are conducted from that account. We could have a general cash account 101, 102, 103, 104. That's fine. We could have multiple of them. But as long as you know how to audit one, you know how to audit the rest. And that's the king account for most organization. Every audit cover begins with this account because it captures the bulk of the organization money flow. It's the main account, and that's the one that you want to audit very much in depth, and don't keep any loose ends, because what do we do with the bank reconciliation? We audit everything 100% with the cash. Then we're going to look at the Imprest account. What's the Imprest account? It's a special purpose account, well, typically established for a specific expense like a payroll, or it could be for any other purpose. And you're going to see what do we mean by specific. For example, what the company would do, knowing that their payroll is 80,000 every week or every 2 weeks or whatever that time is, what they will do, remember they have the king account, the general account. Then what they would do, they will create another account only for payroll. And they know after they did their internal control procedures, they should have $80,000 in payroll. You know, the managers review the time card. The time cards are approved. Everything is matched against the HR. What they will do, they will transfer $80,000 to the payroll account. Then all the checks, all the people that are getting paid, they will withdraw their money from this account. All the wires that occur, all the money that's transferred from this account. Why? Because if we know that the payroll is 80,000, we would create a new account for the payroll. We call it Imprest account, and we transfer 80,000 of it. And guess what's going to happen after all the employees that are legitimately supposed to pay are paid? The account will go down to zero. So the account maintains a set amount of money. Whenever the funds are spent, the account replenished to return to its original amount or whatever amount is needed. Payroll is an example. We're going to look at another Imprest account called petty cash, which is a small immaterial amount. Nevertheless, it illustrates the point. So the account is replenished for the exact amount dispersed or whatever it's needed, ready for the next payroll cycle. So this system stops unauthorized payment and flags problem fast. So if someone, let's assume someone wired additional payroll funds, or they added another paycheck, or they added some hours to their payroll, it will be detected, but because someone will not be paid, because we said it's going to be 80,000, and if anyone try to withdraw more, it will draw a red flag. Someone will not be paid, and they will complain, and we'll have to investigate. So the benefit of this Imprest account is for control and accountability. It enhances internal control, as expenditure are strictly limited to a predefined purpose and predefined amount for that matter. And it also simplifies reconciliation. We're going to see what reconciliation is, because once everyone cleared their checks, everything is good, the amount will go down to zero and everything matches. The balance is known and fixed. Reconciling and auditing this account becomes very easier and very, very efficient. Other type of accounts we could have something called the branch account. Those are individual account used by organization with multiple location. Why? Because you want to decentralize cash operation for efficiency. For example, if you have an operation in California, you'll open a bank account in California, or you have one in Paris, you'd have a bank account in Paris. And the reason you do that, because you want to build stronger local community relations. You want the people in the area, the bankers, know about your business. That's why you open a branch account. We also have a cash equivalent. Cash equivalent are investments easily convertible to cash with 90 days or less, and that's the definition for it. Those include short-term treasury bills and commercial papers. So what is cash equivalent and why is it used? When we have extra money on hand, what we do is we take this money and we'll invest in short-term treasury, commercial papers with 90 days or less. Why they are called cash equivalent? Because they have a maturity of 90 days or less. They're going to be converted to cash. That's one. And they are easily converted to cash. That's two. So if we want the money, we could easily switch them back to cash. Anyway, their maturity is less than 90 days. And we have the petty cash fund. What is the petty cash fund? It's a small preset cash amount used for immediate minor expenses. Like what? For example, let's assume the employees are working overtime and you want to buy them few pizzas, or you ran out of ink for the paper. You don't want to go through the whole vendor procedures to buy the supplies. You might have $200-300, a minor amount on hand for cash to do what? To buy those goods, so you don't need to go through all the processing requirement. Now, often replaced these days by a prepaid card called P-card for convenience and control. So rather than having actual cash on hand, you will have a prepaid card for those type of expenditure. And if you want to learn more about the petty cash fund, you want to go to my intermediate accounting, because this is when you learn about the petty cash fund, the accounting aspect of it. Now, although the petty cash fund, we are going to establish now that it's not material. Usually it's a small amount. Nevertheless, even if fraud taken place, you want to question management integrity. If fraud even taken place, if someone is stealing money, that tells you something about the employees working there. Let's take a look at the integration and relationship of cash accounts. The general cash, we said that's the king. I'm going to put that in the center. The cash account will transfer money to the petty cash. Remember, the petty cash also, what type of an account? It's an Imprest. Imprest means once we transfer $300, once we spend this money, we send them back $300. So the account, it's Imprest. It's fixed at $300. We could also have an Imprest for other purposes, like a payroll. That's usually we transfer money to. Then this money, usually this amount is Imprest for the payroll. The money leaves. Then we have the branch cash. The branch cash might transfer money to the general cash. Sometimes the general cash would transfer money. Then we have cash equivalent. When we have some extra cash, we'll transfer it to the cash equivalent, like we buy some commercial paper or we buy some money market commercial paper. or treasury bills. And once we need the money back, the cash, we'll sell it from the cash equivalent, send it back to the general cash. You notice that the general cash is the central. Now, I told you this earlier that the cash affect all the other cycles, and what I'm doing now is showing you some pictures from other cycles. For example, this is the sales cycle, and the sales cycle, when we sell cash, cash goes up. When we sell on account, account receivable will eventually go up, then account receivable will go down, then cash will go up. So notice cash is affected in the sales cycle. Same thing with the purchasing and accounts payable cycle. When we purchase via cash, cash goes down. When we purchase on account, first accounts payable go up, then we pay off the balance, accounts payable go down, and cash goes down. When we pay for our administrative expenses, expenses go up, cash goes down. When we pay for the selling expenses goes up, cash goes down. When we purchase prepaid. So notice cash is involved in all our purchases or our acquisition. Also, we looked at cash when we looked at the borrowing cycle. When we borrow money, cash goes up. When we pay off liability, cash goes down. Well, when we looked at the inventory and warehousing cycle, just FYI, cash was not affected. We looked at raw material, direct labor, manufacturing, overhead, work in process, finished goods, and cost of goods sold. But keep in mind, if we buy inventory, the inventory itself is affected. Here we are looking at the manufacturing cycle in a sense of warehousing and manufacturing, not the inventory if we're buying and selling inventory. The other thing we want to discuss as a basic understanding of cash, something called as bank reconciliation. What you have on the screen now is a basic bank reconciliation. When we say a bank reconciliation, every time we say reconciliation, it doesn't have to be a bank reconciliation. It means we are reconciling. We're comparing two things and make sure to equal to each other. In a bank reconciliation, we're looking at the bank statement and we're comparing specifically on the bank statement is your cash balance, obviously. We're comparing your cash balance to your company general ledger record, to your cash ledger on the company books. And those two, they should equal to each other. So on one hand, we have the bank statement. On the other hand, we have the general ledger for cash. And what we're trying to do is reconcile, make sure everything in the bank statement is recorded on the books. Everything on the books is also recorded on the bank statement. Why? Because we want to account for everything. We don't want someone withdrawing money or usually withdrawing money from the bank account and not recording this transaction on the books. Also, we don't want someone recording deposit on the books, that's the fear, and not putting that money in the bank. We want everything on the cash ledger in the bank, everything in the bank on the cash ledger. We reconcile them. Now, why do we have to reconcile them? You might be saying, shouldn't they be the same? They should be the same, but that's why we need to reconcile them, because there are timing differences between those two events, something recorded on the bank versus something recorded on the books. As I mentioned at the beginning of this recording, you want to go to my intermediate accounting if you're not familiar with the bank reconciliation. I'm going to briefly go over this, but I want to make sure you understand you need to know bank reconciliation. And that's why I always advise students, if you're going to be taking the CPA exam, take FAR, then take audit. Because on the audit, you might see a bank reconciliation. That's fine. If you know how to prepare a bank reconciliation, perfect. But if not, they would have expect you to know it from FAR. So on the bank reconciliation, you're going to have a bank side. And on the bank side, you would start with your bank balance, whatever your bank balance, for example, 8,350 for our purposes. And you would adjust for outstanding checks. It means you will deduct for outstanding checks, reduce any checks that you wrote, that you deducted from the books, but the bank did not clear. You want to reduce them from your bank balance because eventually they have to be reduced. Then you will add any deposit in transit. So notice here it says add deposit in transit. So you will adjust for outstanding checks and you will add deposit in transit. What are deposit in transit? Deposit in transit for our purposes 1,850,000. Deposit in transit are deposits that you placed in the bank, but the bank did not give you credit for them. Maybe you placed them after hours at the end of the month, or the check they're waiting to give you credit for it. So they are deposit in transit. Eventually they're going to have to give you the money. So for this purpose, the bank statement was 8,350. Deposit in transit were 1,850 minus outstanding checks. Our adjusted or correct or adjusted, let's not call it correct or adjusted, our adjusted bank balance is 9,600. Now we look at our bank book side and we'd say, okay, balance per books as of July 31st, because we're looking at July 31st, 9,250. Notice it's different than the bank balance. Then we have to account for any differences. We will adjust for any bank collection, interest earned by the bank, non-sufficient funds checks that we thought they were good but they were no good, and any bank service charge. Well, what do we have here? We notice that the bank collected $700 on our behalf. We will add the $700. We will notice that the bank deducted $25 fee from our bank account. We will deduct $25 fee from our book balance. We would see that a check for $325 was not cleared. We thought this was a good check. We added it to our book. It was not good. We have to deduct it. So all in all, if we take the book balance, 9,250, add the money that the bank collected for us, $700, maybe a customer paid the bank immediately, deduct the bank fee, deduct the non-sufficient check, we will come up with a bank adjusted balance, or I'm calling it here in quote corrected cash balance. It's really the adjusted balance of 9,600. So I just showed you the ending product of a bank reconciliation. Now, for audit, you might only have to know how to read it. But if you know how to prepare it, guess what? You know everything. You know how to read it, you know how to prepare it, you know everything about it. So that's why you want to be very familiar with the bank reconciliation, because in the next session, when we audit the cash, we're going to be focusing on the bank reconciliation. How? Because everything that you see here, you need evidence. Remember? Audit is what? Is collecting evidence about the figures. So we want to collect evidence about these figures. Now bear in mind some limitation of the bank reconciliation. Why? Because just because you prepare the bank reconciliation, you should not say, well, I should put my hands in cold water because I don't have nothing to worry about. No, the bank reconciliation does not cover everything. There are certain things that you need to be aware of that the bank reconciliation does not identify. For example, unrecorded investment or payment not yet cleared. If you did not record the investment, if you made a payment or you made an investment, you paid for something, you did not record it, so it's not on the books and it's not in the bank because it hasn't cleared the bank, it's not going to show. The bank reconciliation does not know about this. Eventually it will clear the bank and you would say, well, it's in the bank but it's not on the books. But if it's unrecorded and not yet cleared, it's like you're not aware of it. Okay, the bank reconciliation does not catch it. Inappropriate payments such as personal expenses. If there's any personal expenses, somebody slip a payment, and if they recorded the payment and it cleared, you have to look very carefully. The bank reconciliation does not say, well, hold on a second, this is a personal expense. You have to look a little bit further to make sure the purpose of it. Or any related party transaction without appropriate disclosure. Also, it doesn't tell you about related party transaction. If you purchased from someone or paid someone that's related party, it doesn't tell you that because the check clears for the proper amount, and that's all what the bank reconciliation will show. If you overpaid someone, it's not going to tell you overpaid them. Whatever you paid, the bank will clear the check, and if you recorded it for that amount, it doesn't tell you anything about the overpayment. It doesn't tell you about duplicate payments, not yet reported or recognized, but the software will tell you, you can tell the software, flag any duplicate payments. But the bank reconciliation, if you have, let's assume you have 300 checks for that month, and few of them are duplicates, okay? Unless they are next to each other and you're physically looking at them, you're going to miss them. Because if you're looking at 300 checks, they're going to be all over the place. Now, Excel's simple software can, if you suspect that as part of your fraud or additional testing, you could look for duplicate checks, duplicate payments, duplicate amounts. You could look for the vendor if they paid the vendor more than once, which is probable, but if they paid the vendor more than once the same amount, it could be, but you want to know about this. That's why you want to look at duplicate payments. So those are the things that are limitation of the bank reconciliation. But the bank reconciliation is a great internal control mechanism for cash, and we're going to see it heavily in the next recording, because in the next recording, we're going to dive into what? Auditing the cash payment. Now, before we end, let's go ahead and take a look at a multiple choice question from farhatlectures.com. Which of the following best describe an Imprest petty cash fund. So what's a petty cash fund? Specifically an Imprest one. An Imprest petty cash fund is a bank savings account. Now, it's not an equivalent of a savings account. Savings account is a type of account. An Imprest petty cash fund is used to provide immediate funds for significant cash acquisition. While partly true, an Imprest cash fund is used to provide immediate funds. That's the purpose of the petty cash. You want some cash to spend real quick. You don't want to go through the whole approving process. But it's not for significant cash acquisition. Usually it's for small immaterial amount. An Imprest petty cash usually has an immaterial balance. That is true. Usually it's an immaterial, $200, $50, $300, a small amount. So I would say between A, B, and C, I'm going to keep C. An Imprest petty cash fund is used to settle employee monthly payroll checks. No, we're going to have an Imprest payroll cash account, but not petty cash. That's totally different. So the correct answer is C. C as in Charlie. What should you do now? You want to go to Farhat lectures. Look at additional resources, multiple choice, true false lectures. That's going to help you whether you are an accounting student or a CPA exam candidate. The best investment you can make is invest in yourself. Good luck, study hard, and of course, stay safe.